What is up, everyone? Welcome back. So today we're going to be, continuing the series that we've been doing on trading stocks using data science, but we're going to be doing it in a fundamentally different way than we've been doing with all of the previous videos. The previous videos covered many different ways to trade stocks, the Sharpe ratio, the ARMA model, LSTM models, and so on, but you can fit them all into a bucket of, I'm going to train some kind of model, whether it's simple or whether it's complicated, on a bunch of historical data about these stocks, and then I'm going to use just that historical data to figure out which stocks I should be buying in the next week, and then we'll see what happens if we end up beating the market. This strategy is different because it falls in the realm of a subsection of data science called reinforcement learning. Now, we've covered a bunch of reinforcement learning topics on this channel, like multi-arm bandits, Thompson sampling, so on. But the general, very intuitive idea behind reinforcement learning is saying, you know what, here's my belief about how a certain variable will act in the future, here's my prediction right now, but I'm going to adjust that prediction, I'm going to update that prediction based on what actually happens tomorrow. And then I'm going to update that prediction based on what happens the next day, and so on. And you can see how this gets the name reinforcement learning, because we're reinforcing our beliefs, we're reinforcing what we believe and what we don't believe based on actual things happening in the world, so that our prediction on any given day becomes a mixture of our belief before we saw any data, updated with the actual data we saw. It becomes a mixture of these two things. And that gets us into the strategy today, which we're going to call Bayesian stock trading. Trading stocks in such a way that I'm not going to decide on Monday, here's what I'm going to buy for the entire week, but rather updating what I buy and how much of that I buy, the relative allocation, based on how those stocks actually perform on Monday, then updating again based on how those perform on Tuesday, Wednesday, Thursday, and so on. So let's get into the nitty-gritty of the method. We're going to get into the mathematics here. And then at the end of the video, we'll see how we actually do on trading 1,000 real-life dollars using this strategy. Does it do better? Does it do worse than the market? We'll break it all down. So we're going to start by saying, let's say we've got some stock S. It can be anything, Microsoft, Tesla, put your favorite stock right there. And assume that the expected daily return of your stock S is normally distributed with some mean, mu, and some standard deviation, sigma. Now there's going to be tons of assumptions in here, and you can adjust those assumptions and see what happens. One such assumption is the normal distribution. We know that the return of a stock can be positive or negative, and so the normal distribution, also being this unbounded kind of distribution that's very commonly used in data science, seems like an easy fit here. Possibly not the best fit, but it's convenient to move forward with for now. But more importantly, what are we actually saying? We're saying that there's some kind of daily return for our stock S, and we're going to assume that that daily return on any given day, Monday, Tuesday, Wednesday, whatever day we're looking at, is normally distributed with some mean mu, that's the average daily return, and some variance or some volatility, sigma, that's the volatility in the return we would expect. The higher that is, the more uncertain we are about what the return will be, and the lower that is, the more certain we are about what the return is going to be. And so if I draw that in a picture, we said that there's some mu. Here it's a positive mu because it's on the right-hand side of this 0 line. And there's some variance or standard deviation here. Now, here's where the Bayesian part comes in. Here's where we start thinking about updating our beliefs. Let's think about this mu for a second. What is that mu? What does that mu mean? That mu is the average return, the center of the distribution that we've created here. Now, that's not something we know for sure in the world of stocks. I can't just say the average return of Tesla is this. That mu, as weird as this is going to sound, itself has some uncertainty built into it. I can go and say the average return of Tesla stock is 0.5% per day, but that's not going to be the absolute truth. That answer I gave about the average return of any given stock S itself, that average itself is going to have uncertainty baked into it. And so we're actually going to take a step back from modeling this distribution of each day's return to also incorporating the uncertainty of the average return, the center of this distribution. And so if that doesn't make sense yet, I'm going to try to describe it in a couple different ways as we move on here. So we're saying this mu, this average return of our stock itself has some uncertainty. And so we can capture this uncertainty by also modeling this mu, modeling this average return of our stock itself by a normal distribution, which itself has parameters mu prime and sigma prime squared. And we can draw a picture just like that here. Now, before we move on with this, I do understand that this is a weird concept to grasp, especially if you haven't thought about reinforcement learning and Bayesian statistics before. And so let's break it down just a little bit more. Actually, it works if we tell the story from right to left now. We say that, you know what, the average return of my stock, I'm not exactly sure what it is, but I know that I can model that average return of my stock as a normal distribution centered at mu prime. So centered at mu prime, which is this dashed line here, which happens to be negative in this case, and with a variance of sigma prime squared, a standard deviation of sigma prime. So that tells us about the width of this distribution. What that means is that if I just sample from this normal distribution randomly, I'm most likely going to get a negative number because the center is negative, but I might, and let's say I end up getting a positive number here. So if I roll with that positive number, as unlikely it is to be selected, then I can come back to the left side here and say that if this sampled average return from this distribution here is what I think it is, this positive number right here, then that becomes exactly the positive number, which becomes the center of my returns distribution. And now I'm saying that given that this is the average return of my stock, I can plug that right there, and I have this other normal distribution which gives me the actual return of the stock on any given day. So it's this two-step process. First, I sample the average return of my stock. Then given that average return of my stock, I sample the actual return of my stock on any given day. So hopefully that whole narrative makes sense, and if it does, then the rest of this is going to be a breeze. The process that we're going to use proceeds as follows. We're going to start by assigning what's called in the Bayesian statistics world a prior, which means that in the absence of any data, in the absence of any actual returns that I've observed about my stock, I'm going to set some kind of prior belief, some kind of prior distribution of this average return of my stock, and that's going to be mu naught sigma naught squared. We're going to say whether you're talking about Tesla stock or Apple stock or Southwest stock, we're going to assume that all of their average returns in the absence of observing any data are all just going to be the same exact normal distribution with this mu naught and this sigma naught. That's going to be based off of the average daily returns of many tickers. If I look at all of the tickers in the S&P 500, I can go ahead and get this prior distribution, which is going to be the same for all of them. And now here's where the method gets really interesting. You might be thinking, well, if I'm just assuming the same prior distribution for all of them, how do I actually know which one is the right one to buy? And that's where this updating of our beliefs comes in. And now what happens is, let's say one day goes by and you observe the actual returns for all of these stocks that you're considering. Let's say for the stock S that we're considering, the first day's return is R1. That's the actual, literal, real-life return that we're seeing for this stock. And just like this, we have the same return for all of the other stocks we may be considering. Now, some of those returns are going to be very strongly positive. Other of those returns are going to be very strongly negative, and many of those returns are going to be close to zero, either positive or negative. But the thing is, using this new information, using the first return, the first day's actual return, we should update our belief about the average return of each stock. So just to be very simple here, let's just say we have two stocks, A and B. Before observing this first day of actual return, we have the same belief of both of them about their average returns. We have the same distribution of their average returns, mu. Now let's say after the first day, A has a very strong performance, and let's say B has a very, very negative performance. What that means is we should update those beliefs, which were before at the exact same place. We should update them such that the mu for our stock A should go up and the mu for our stock B should go down. It shouldn't be solely based on the first day's returns because that's not a lot of data to go off of, but instead it should be based on a mixture of these priors, which were based on a bunch of historical data aggregated across many, many, many different ticker symbols, many, many stocks, and incorporate a little bit of this evidence that we're seeing because we have to give some credence. We have to give some weight to the fact that the return of A was very positive today and the return of B was very negative today. But we don't want to drastically update them. We just want to nudge them in those respective directions. If you think more mathematically, then what we're doing is basically saying our probability or our belief about this average return of any given stock given the data that we just saw, whether that's 1 day of data, 7 days of data, 30 days of data, whatever that might be, by using the Bayes theorem, is going to be proportional to, so that symbol is proportional to, the probability of observing this data, given that mu, times the probability of that mu not conditional on anything. And now this might seem like a lot of gibberish, but these actually all have names that we've talked about. This first one here is called a prior. This is our prior belief about the average return of any given stock, absent of any data. Notice there's no conditional on data right here. This piece right here is what's actually allowing us to do the updating of that prior, and this piece right here is called the likelihood. The likelihood. This likelihood is asking the very important question, given that mu that you just set before was actually correct, what's the probability that I would actually see this data that I'm seeing in the real world? Now, if that's a very high number, then because these things are proportional and they're all positive numbers, our term on the left here is also going to be a high number. And our term on the left is asking, what's the probability of this mu given the data that I actually saw in the real world? So if this is very high, then what we're doing is reinforcing our belief that that mu was actually correct. If this mu is actually correct, then the probability of observing this data in the world given that mu is going to be very high, which means that conversely, the probability that that mu is correct given the data we saw in the world is also going to be very high. The reverse of that story would be if our mu was very, very off of the truth, then the probability of observing this data that we actually saw for a ticker, given that wrong belief, is going to be very low. It's going to be very, very unlikely, which is in turn going to cause our term on the left, the probability that this mu is correct, given all of the data we saw in the real world, to be also very low. And so we're going to seek out other mu's, other averages of these return distributions that are going to be more correct, and update that accordingly, update our mu accordingly. And so this last term here is called the posterior. The posterior. The posterior is basically asking, how likely is this mu now, given that I observed this data in the real world? And so the punchline, the way this method actually works is that we're going to decide how much money to invest dynamically each day. And this is the key benefit, and as we'll see, possibly also the downfall of this method. We're going to dynamically allocate our money each day proportional to the mu, which maximizes each of these probabilities. Because going back to our simple A and B case, once we see the first day of data, there's going to be some updated mu which maximizes this quantity for the stock A, and there's going to be a different mu which maximizes this posterior for the stock B. Now, as we saw before, that mu A is going to be higher than that mu B, and so we're going to dynamically allocate more of our money for Tuesday to stock A than stock B. And so, for example, let's say we have this small list of tickers that we're considering, A, B, C, and D, and this column here is going to be the mu which maximizes this posterior quantity. So this is a little bit of abusive notation here. This is not actually the probability that mu given the data. This is not the posterior itself, but rather it's the mu which maximizes that posterior for ticker A, for ticker B, C, and D, respectively. So for ticker A, we find that the mu that maximizes that posterior is going to be 0.5%, which means that my current belief about the average return of stock ticker A is 0.5% growth per day. For B, it's 0.3% growth per day. For C, it's 0.2%, and for D, it's negative 0.2%. The way this method works from here is very simple. We simply disregard any tickers who have a negative return, because if my beliefs are correct, there's no reason I should invest in something the next day that's expected to give me a negative return. So we're really just considering A, B, and C here. Then we allocate our, in this case, $1,000 for the next day proportionally to these different maximizing mu's. So we're going to put $500 into stock A for the next day. We're going to put $300 into stock B for the next day, and $200 into stock C for the next day. So just to recap our method before we dive into some pros and cons and then finally look at some results, we're going to take a look at a bunch of different candidate stocks in the S&P 500. We're going to start by assuming the average return of each of those stocks is some prior normal distribution, all with the same mean, mu naught, and all with the same variance, sigma naught squared. And those terms are based on the average daily returns of all of these tickers. Basically, I'm saying that I'm not going to assume anything special about any of these different tickers. I'm going to assume they're all starting from the same place by pooling information about all of these tickers together. Then, as the days go by, Monday we observe the actual return of each of those stocks, Tuesday we observe the actual return of each of those stocks again, and so on and so on and so on. After each day, we check in with our method again and say that, I know you had some belief about your mu so far. I would like you to update that belief using the data that you just saw in order to tell me what is the new best guess we have, using the posterior, about the average return of each stock. That's going to be a different answer for each of our tickers based on the actual data that we saw for those tickers so far. And then, to determine what we're going to do the next day, we're going to proportionally allocate our $1,000 based on these updated beliefs about the average returns. And we do that for 7 days, and we're going to compare that to a baseline strategy of just investing all of that money into the S&P 500, into the entire market, and just forgetting about it for a week. And that brings us to our list of pros and cons, after which we will talk about the actual results of this method. So the pros and cons here, I've made it seem like this is an amazing method and it's dynamically allocating money, so shouldn't this be better than just setting which stocks you're going to buy on day one and forgetting about it for a week? Because this is so hands-on, surely it has to be better. And let's talk about those better characteristics. It has a smart dynamic allocation. That's exactly what we just talked about. We're not just setting and forgetting. We're dynamically hands-on tuning how much money we're investing in each of these stocks. Another subtle benefit here comes from our setting of the prior. Because the prior is aggregating information from all stocks, it's actually less sensitive to small fluctuations, whether positive or negative for each individual stock. And the way to best see that is back on this page. Let's say that stock A has an amazing day. It gets like a 5% return in one day. Now, on one hand, that's awesome, but on the other hand, it's a little bit suspicious and it's unsure if that pattern would continue and if we should really reinvest all of our money into A based on that just one day of really good return. This method has all that baked in already because our prior is going to incorporate information about all of the stocks that we're looking at. And while the data for stock A is very positive for that day, it will nudge our mu. It'll update our mu for stock A a little bit in the positive direction, but it won't update it nearly as much as if we didn't have that prior in the first place to kind of ground the return, the average return for stock A in a more realistic place. We're not going to let it get too high, we're just going to let it update a little bit, but it still needs to be a balance between the actual data we saw and the prior we were looking at. So it can only update a little bit from that prior. So we're basically protecting ourselves from huge swings, which we know is a very real thing in the stock trading world. Either huge swings positively or huge swings negatively. And that seems like a positive thing, and it totally can be, but that gets us into the cons as well. And the cons really come when it exactly is these huge swings in the positive or negative direction that you do want to pay attention to. And we call that two effects. There's the miss the boom effect, and there's the blind to the bust effect. The miss the boom effect you can think of as, let's say stock A was having a really strong positive couple days. If we weren't using a prior, if we weren't grounding these positive returns in reality, then we would hop on stock A a lot sooner. But because of this method, we are trying to be a little bit safe. We're protecting, we're regularizing these returns against the returns of all other stocks. And so we might jump on this train of stock A on the third day maybe, but maybe by the third day those returns have turned negative. And so we miss the boom here. In that same way, we might be blind to the bust. So the story here is the exact opposite. Let's say that there's a stock B, and let's say that it has a very, very negative couple days. Now, because we're not treating that too significantly, we're saying, you know what, I want to regularize that against the returns of all other stocks. We might continue investing some money in B, and if this negative trend continues and we were too late to jump on that negative trend or react to that negative trend, we might end up losing a lot of money in this process. And the biggest, I think, downside of this method, compared to these other methods we've been looking at before, is that this is very, very, very hands-on. You basically need to update these posterior distributions every single day and then dynamically pull your money out of where it's at, reallocate it in, and it's a lot of work for someone who's not necessarily trying to be that hands-on, if you're a more passive investor. And so what that means in another sense is that this better give us way higher returns than our lazy methods, because if this gives us even the same return as our lazy methods, then I'd rather just do the lazy method. I don't want to be logging on to my stock trading platform every day and doing all this. It's just a hassle and it's really messy. So that said, let's take a couple minutes and actually look at the results. All right, so let's take a look at the actual results. Here in this experiment, we've just looked at 5 different stocks, and we've dynamically reallocated our money on each of the 7 days of the week. And so we've reinvested those $1,000 based on the Muse, which maximize these posterior distributions. And so before looking at the results, I just want to get a better sense of this method. So here's a stock whose ticker symbol is CEG. This green line is showing the actual return on each day of the week. And this blue line is showing the posterior, so both the center of that posterior distribution, but also the variance of that posterior distribution. One of the clear things that stands out here is that these error bars are never clearly positive or clearly negative, which means that even when we allocate things proportional to the center or the mean of these posterior distributions, there is still going to be a ton of uncertainty built in. These normal distributions still have just a ton of uncertainty. The next thing I want to look at is how this posterior distribution center is reacting to the actual growth rate of this stock. So for example, notice on the first day, this is just a prior, but notice on the day after, the return of the stock did go up, and our posterior distribution did go up in reaction to that. But it did not go up by nearly as much. Notice the scale on this actual return graph is about 10 times the scale on this posterior return graph, which echoes the fact that we are making minor adjustments. We're making adjustments keeping both the actual returns, the data we're seeing day to day, but also that prior in mind as we make these adjustments. So we're playing it safe. The next day, the actual return goes up again, and we update our posterior in the positive direction again. The next day, the return actually goes down, and we kind of keep the posterior flat here. We're saying, you know what, I'm not going to increase it, I'm also not going to decrease it by too much. I'm going to keep it flat and see what happens next. Then it gets positive again, and I could just continue this story. So in a nutshell, what I'm trying to say is that if you look at the shapes of these green curves for each stock, these green curves showing the actual returns day to day, and compare that with the shape of these blue curves, the center of these blue curves, you'll notice they have similar shapes, but the blue curves are being much less risky. They're saying that I'm just going to make these minor adjustments, taking into account the data that I'm seeing, but also sticking to the prior, also very heavily weighting the prior distribution that I was looking at in the very beginning. And so we can look at which stocks, we can look at our allocation on any given day. On the first day, in the absence of any data, we simply invest $200 of our $1,000, so an equal amount in each of these 5 ticker symbols. These 5 ticker symbols, by the way, were chosen based on their Sharpe ratios historically, and so that's how we got the tickers we're going to use in the experiment. But as the experiment moves on, you can see that things change, sometimes very drastically. For example, this ticker EPI gets all of our $1,000 on the next day. And to explain that, we can come back up to these graphs and say that on the first day, the posterior mean for each of our distributions is negative. For LLY stock, it's negative. For UUP, it's negative. For EPI, that's the only one where it's positive. And so based on our rules, we're going to put all of our money for that day into EPI because we believe it's going to be remaining positive over the next day. Now, just out of curiosity, was that actually true? So EPI, we put all our money in there on this day. The next day, the return was in fact positive, so we got close to a 1% return on that day, and this method paid off. On the next day, it seems like many more. 4 out of the 5 of our stocks were actually positive. So notice LLY is positive, UUP is not, EPI is positive, YCS is positive, CEG is positive. And so we put our money into those 4 stocks proportionally based on the means of their posterior distributions. And you can see the allocation changes day to day to day. And so it seems like there's a lot of smart stuff happening here. And so when we scroll down, we can finally see the results of this method. So the results, the return from our Bayesian method over the course of this whole week was a growth of 0.6% of our money. And so we put $1,000 in, and so that represents a gain of $6 whole. Nice. But not so nice. Because if we look at the same return over that period, if we had just bought the S&P 500, bought $1,000 of the S&P 500 on Monday and sold that on Friday, then the return there was 1.6% or $16, which is almost 3 times the growth from our method. And so I want to be very, very clear here that this method did not do as well as even just buying the S&P 500. I also want to be clear that this was just based on one arbitrary week of the year that I decided to run this strategy. It's unclear what would happen We probably need to do some backtesting to figure out if this is a general negative trend or could be more of a positive trend. But that said, if we did want to hypothesize why this method did not do as well, I would point back to those cons. It's quite likely that we ran into those effects of not catching onto the booms as quickly as we should have, kind of waiting to see if the stock kept being positive, but then getting on that too late. And we also probably did not react to negative trends as much as we should have. Seeing that stocks were being negative, we were sticking too much to the prior and continuing to invest in those stocks, which ended up giving us negative returns the next day. In a nutshell, it's very difficult to run these reinforcement learning methods properly on stocks. And the reason is because stocks are such a finicky and fickle thing, where expecting what was happening the last day or even the last 2 days to continue the next day is generally not going to be true. If that was true, then everyone would be making a ton of money using stock trading methods that were just based on, hey, if it was doing well yesterday, buy it today. If it wasn't doing well yesterday, don't buy it today. But we know that there's a ton of volatility built into stocks, and our method even tells us that much. If you look at any of those error bars, as I mentioned before, I would guess none of them, as we scroll from here, are going to be completely positive or completely negative. And the story they're saying there is, you know what, I think the center of your posterior distribution is positive right here. I think that you're going to get a positive return based on the data and based on the prior, but here's your uncertainty. It's completely possible. There's a very high chance that you're going to get a negative return. And so yet again, we see a strategy where it seemed good in theory, seems like it has a lot going for it, but when you actually put it into practice, it does worse than just buying the S&P 500 for a week and selling that at the end of the week. So if you have any thoughts or questions or think that there could be improvements to this method or other things we should try in the future, please post them in the comments section below. Thanks so much for watching. Like and subscribe for more videos just like this, and I will see all you wonderful people next time.